What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house. It's going to be torn down soon. I understand that there are power lines that are just kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. Hey there, my 9-year-old daughter has a reminder for you using this paper katana, and that is to make sure you hit the gear and use the speed controls, because it changes it from this, ready, into this. Like magic. I'm joined today with Brandon. Is it Howliet? Is that how you pronounce your last name?
Howliet.
Howlett. Okay, yeah. So there you go. Howlett. Good. And how are you doing today, Brandon?
Pretty good. How about yourself, Dan? Thanks for inviting me.
Oh, I'm fantastic, especially because I don't know if you're aware of this or not, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? Well, because this is a chance encounter where I interview commercial real estate players. That means buyers, sellers, passive investors, deal sponsors, all that sort of thing. And you might be thinking, why you do that? And the answer is, if you've ever heard of private off-market deals that you're not allowed to publicly discuss, then you should know that the SEC requires documentation of your prior substantive relationship, or else they might get ants in their pants and take your business away in the form of rescission. That's bad. So I have people on here and we talk about your buy box, your core competencies that you're going to be contributing to a GP team. And the benefit to you is you're going to learn how to more effectively communicate on the subject of commercial real estate deals. And if you're looking to get into real estate, your success is going to hinge on that. But before we get too into the weeds, Brandon, do you want to introduce yourself a little bit for the audience?
Yeah, thanks, Dan. My name is Brandon Howlett. I own a company, Brandstar Capital. I am based in Chicago, Illinois, but my team focuses on apartment building syndication deals in the Dallas DFW area and Louisville, Kentucky.
I love it. I love it. So the first segment that I always go through here in these different chance encounters, it's the 5 distinct motivations. Before I get too deep into that, though, I gotta say, but wait, check your 8. Now, Brandon, I don't know your level of technical acumen, but can you try to look through the camera there and down into the audience's device down there? Because there might be this big, ugly subscribe button, and they really ought to do something about... Okay, it's just a stupid joke, but whatever. I always do it. It's been hundreds of episodes already, but let's get started. Now, everybody in real estate is human, and that means they have their own unique reason why they're involved. Now, of course, as a real estate investor, you're going to need to know what that motivation is because, hey, when the going gets tough, what's going to keep somebody from throwing in the towel? Now, even though every reason is unique, maybe it's a different face, a different name, I find that they fit pretty neatly into these 5 different distinct categories, and so we're going to go through each one of them to find out what combination of them really describes my guest best. The first one of which is preservation of purchasing power. What on earth is that? Some people already have a portfolio of assets, and so they're work optional or they don't work at all. They basically make ends meet from the proceeds of ownership. Other people, they are high net worth individuals, high income earning professionals such as attorneys, engineers, physicians, and whatnot. And those guys, they're going to be investing part of their income each year into some sort of investment. And so they're deciding, okay, well, we'll make part of it commercial real estate. Now, of course, the thing that is special about people who have this as their motivation, preserving their purchasing power, is that they're not going to be making deals every 10 seconds because it makes more sense either, if inflation's rearing its ugly head, of course, they're going to have to make another acquisition to compensate for that dent in their cash flow. But in general, they're going to be negotiating the deepest, steepest discount that they possibly can, which is just common sense. Everybody should be trying to negotiate the best discount that they can. However, these guys here, they're not going to be making deals all the time like the people who are not at this phase. Just like myself, I'm not at that point in my career yet. What describes me better is trading time directly for wealth. My background is in technology, specifically the CRM and online funnels industry. And so because of that, I found that I was chasing these bigger and better salaries, these higher wages and whatnot. Yet once I started working in 2014 for a guy who was doing 10 single family flips per month, or at least transactions per month, I figured out that I was on the wrong side of the right business. So I started pursuing compensation in the form of deployed capital, aka equity. So that's what my main drive is when it comes to being involved in these commercial real estate deals. But of course, I understand that that's subtle, especially for youngsters. They don't really get that kind of approach. And what describes them more often than not is they want to either take control of their schedule or they just want to hustle like crazy right now so they can fast track their retirement. The only flaw in that way of thinking sometimes is that people think that secretly everybody is trying to retire early, and I assure you that's simply not the case. There are plenty of people in commercial real estate that they're going to hustle into their 90s. For example, the people who want to buy their entire hometown, they are after that generational wealth. They want to make sure that their great-grandchildren never have to hold a day job. And even though some people will vilify that attitude, that level of ambition, you have to remember that somebody has to be there taking care of the properties. They can't be asleep at the wheel. You have to make sure that residents and people who lease the property are happy to continue renting there. And so that it means that you need that level of dedication, and they're great parts of your GP team. And then the last group of these 5 distinct motivations, they're not so much after their own generational wealth. Maybe they've picked a sector of society, maybe it's animals, maybe it's the environment, who knows? But they figured out if they want to make a big impact in the world, there's a financial component to it, and that's why they are approaching these commercial deals. So Brandon, these 5 different motivations, what combination of them would you say describes you best?
Oh, well, I would say the financial freedom part of it. I was always looking for an avenue to invest in real estate. Got into single families first. But every deal, I was making myself another job, right? And I'm not too handy, but I do love doing the deals. Went into the laundromat business. That was even more labor intensive there. But multifamily was where I ultimately wanted to be. Did some research through COVID. Managed to sign up with a mentoring program and got into the business. It's a lot more on the passive side, meaning that you do the deal, you get the property manager to manage the deal, and you basically manage the property manager and the asset, and you can basically scale quicker and larger with that approach. So, yeah, that's ultimately what got me here to where I am now.
I love it. I love it. And the next segment we have here, it all stems from the first time I was involved in one of these syndications, these passive deals. What happens is anybody who's involved as a partner, either a GP or an LP, one of the things the SEC wants for these to be involved in the private deals that you're not allowed to publicly discuss is that you fill out the documentation. There's a suitability questionnaire. It's a financial questionnaire, all sorts of invasive questions like net worth, income, investment experience, all that kind of stuff. And that's all well and good. But when I was going through the questionnaire myself, I found one question in particular was problematic because it lacked utility, and that's the tolerance for risk assessment question. And that's because it didn't matter which of the multiple choice answers you chose. I felt you couldn't really use the answer. It didn't really give you a clear idea of the person's perception for risk. So in these interviews, I made up my own one, which is a fill in the blanks question. And it is, there are many popular investment asset classes, but I think blank is too risky. So Brandon, it can be inside real estate, it can be outside real estate. You can give one of each if you want. What's too risky for you to invest in?
I would think it would be the stock market. Right now, I'm into my I know I look like a young man, but I'm in my early 50s, and the stock market is basically for the long game, right? So, and you have to be very vigilant watching and tracking that investment. And, I just don't enjoy doing that, and it's a little bit too volatile for me.
I love that answer. My biggest thing of why I'm not crazy about the stock market is because they all have PR departments, which is an entire department whose job is to spin whatever is going on in a way to make it sound more palatable. Whereas if you're involved in a syndication or one of these deals, you have direct access to the people who are calling the shots. So I think that there's more opportunity to have more of a feeling of control. So I love that answer. But my next slide here, I got to confess, the first few hundred of these chance encounters, I didn't include this because I thought it was a little bit too fastball for some people in this real estate industry. Specifically, it's the ones that are more in public relations or marketing or something like that. They're not really the people who will dive into a spreadsheet. Maybe there are some of the details in underwriting a property that they don't really fully have their head around yet. But I found that everybody is a curator of deals to some extent. They have to say this one looks good and this one doesn't look as good. So they're going to have some net metrics that they know and are comfortable and use to base their decisions to make the acquisition or not. And for anybody in the audience who's listening and not watching, I read out these 14 to basically jog my guest's memory. And here they are. The first one is cash on cash. And then there's IRR, which is internal rate of return. It's also known as an equity multiple. In other words, if you put in, say, 100K, what sort of multiple of that are you going to end up with when you've gone full cycle as far as the projections go? Then there's the cost per door. There's the net operating income of the property. There's the going in cap rate, which is basically because commercial brokers, they tend to publish the cap rate for any given metropolitan. And so you can get it's a back of the envelope way to find out what sort of discount you're getting really, really easily. Next, there's the loan interest rate, which is particularly important if you are going to be assuming a loan. Then there's the occupancy rate. Keep in mind that occupancy is the inverse of vacancy. So same number, just inverted. And so don't think that that's something different. Keep in mind that vacancy really is the deal killer. That's a really key one. Then, of course, there's the average income where the property is located to get an idea of how much disposable income or how much income can be devoted towards rent in general. There's the amortization period of the loan. There's the difference between the market versus the in-place rent. Then there's the population growth where the property is located to give an idea of some baked in demand. Then there's the sponsor record, which is how many deals have already gone full cycle, how many deals are on the go right now, that sort of thing. Then there's the waterfall split or exit strategy. In other words, what happens to your capital after the investment has gone full cycle? Are you going to stay in? Is it going to be a refinance and you stay in, or are you going to have to find another deal? And then the last one I have here is DSCR, which is debt service coverage ratio, which has to do with how much of the revenue from rents and amenities is basically out the door immediately just to pay for the loan. So Brandon, of course, it's not an exhaustive list, so if you have something that's not on here, you're more than welcome to mention it, but do you want to give a top three or something like that?
Yeah, Dan, and this was great here. This is the holy grail of multifamily, right? So these are definitely the terms that you have to know, and you have to be able to define these also to investors as well. Right now, the deal that we're closing on the next couple of weeks, the first week of November, we have like some benchmarks that we want to hit for our matrix of every deal. Right now, the deal that we're looking at is 19% average annual return, 15% IRR. Cash on cash is 6%, which is excellent. We've got an excellent loan rate. It's a agency loan from Fannie Mae, which is one of the best multifamily loans that you can ever get. But they do create a few challenges. You have to have your T's crossed and your I's dotted when you're dealing with them. But they give the best rates. The area in which we are in with that deal, Apple is making a $600 billion tech investment there. It's a tech town. It's a great up and coming and growing town there. The sponsor that we have, who's also my key principal and my mentor and has been since I started for the last almost 4 years now. Collectively, we've done, we're into 17 deals, and about half of those have gone full cycle. And usually, the waterfall for that deal, for those deals, we usually try to stay 70-30, 70% to limited partners and 30% to the general partners, the active investor team, which is my team.
All right, excellent, excellent. And then for legal reasons, don't forget that those are projections, but I'm gobbling up that answer like a delicious subscribe sandwich. Is that intense or what? But that's my reminder. It's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. Brandon already mentioned the KP, the key principal, who's that's kind of the surprise at the end of this. But as I go through this, this is really going to help you understand how my guest fits into these deals, what their role or actual piece of the puzzle really is. And as I'm going through this, if you're thinking, hey, I really need to get me one of those cubes, the good news, it's absolutely free. You go to dandoesdeals.com and you can end up getting one of those absolutely for free. It goes straight to the it goes straight to the PDF, and you can print it out and glue it together like craft time, like it's kindergarten again. But let's get started. The first role that I'm going to discuss is the repositioner role. You're more likely to meet a repositioner in commercial real estate than anybody else. And the reason for that is because they're public facing, but they're also the deal finders. One of the big ideas, the reason why I have a picture of a bunch of properties and a bunch of paperwork here, is because the repositioner is going to do some sort of underwriting because they have to find the upside. The first part is finding out is the property actually even making the amount of money that the seller slash broker claims it is, because that's no guarantee at all. But if I were to think of one thing as far as finding this upside that's a little counterintuitive, or unintuitive at least, about repositioners, is you'll probably ask, why do they have such a wide circle of financiers, lenders, investors, all that sort of stuff? Why do they spend so much time rubbing elbows with those people? Now, of course, commercial real estate is a very capital intensive business. So everybody in real estate is eager to meet more people who want to invest and get some proceeds from their real estate deals. But the real reason for that is because cheaper money, in other words, less expensive loans, they go straight to the profitability of the building. So that's why it's important to meet lots of financiers who they do not get involved in unclogging toilets or collecting rents or mowing lawns. They are not operators. They only deal with the owners, the paperwork, and the capital. So that's what a financier is. Now, of course, the next place that a repositioner is going to try to optimize when it comes to one of these properties is they're going to look at operations. They're going to figure out, where are these Benjamins going down the toilet? Now, of course, there's more to operations than simply unclogging toilets and mowing lawns and collecting rents. Me personally, my GP experience and the way that I tend to throw my hat in the ring is a combination of my digital skills, so any kind of digital assets, the social media, and also any automation, inventory control, that sort of thing. Also making sure that online meetings, remote-based meetings run nice and smoothly and don't run into too many technical glitches. But one of the other things that my GP teams in the past have been appreciative of is the fact that if you understand that vacancy truly is the enemy, then even if you're looking at bigger properties such as I do, 100 units or more, that sort of thing, then you need to understand that you may be outsourcing your property management, your operations, to a third party, but if they can't get the units filled, somebody on the GP team has to have some serious marketing chops, and so that's where I sub in. But of course, there's only so much you can do as far as optimizations of operations. So the next thing a repositioner will frequently do is they'll get a contractor team involved to renovate the place. If the place is nicer, then the future residents and even the present residents, they'll be happy to pay more in rent than the previous ones. And so that way you can find some additional upside. Now, of course, if only things were that simple. You can spend endless amounts of money on contractors and renovations. You can gold plate the toilets if that's what you want to do, but you're not going to get a return on your investment. And of course, you also have to put in a little bit more effort to make sure that they're staying to schedule and they're also not using subpar materials. So if you're like me, see, I don't know if you know this about me, but I'm from the internet. That means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because categorically, that won't be me. I'd still be stuck at an airport in an hour or two. So I need to have somebody who lives nearby, who can check in on the property, make sure that the contracting team is keeping to schedule, not using subpar materials and all that, and make sure that the operations team, they're not sloughing photographs, misrepresenting the truth, or causing residents or whatever, like if it's a commercial property such as retail or something like that, making sure that things are actually running the way they ought to. That's what the local's up to. Now, of course, Brandon already mentioned the sixth and final side of the cube here, and I like to use a hypothetical to explain it a little bit more. Let's say you're an engineer or an attorney or a physician or something like that. Maybe you already have some Airbnbs, some different rental properties, a duplex or something like that. So you got a pretty good idea of how owning real estate for rental purposes really works. So you might get this idea in your head, hey, I see that great big 350 unit apartment complex down the street. So maybe if I turn around to my buddies at the hospital or the firm or whatever it is, and we say, hey, let's all kick in 100K each or something like that, and we can take over that building. So full of confidence, you turn around to the financiers at the bank and you say, hey, I want to buy that building over there that's tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Well, that's where the KP comes in. And if you are in a mentorship program or you have some sort of guru or something like that, pay especially close attention to this. A KP is a person who already owns a similar asset. You are not going to be eligible for a commercial loan unless somebody in the fold already owns a similar asset. In other words, if you're looking to take over a 350 unit apartment complex, somebody has to already own a 350 unit apartment complex to prove to the lenders that you're not just going to take all the depositor's capital and blow it all and make it unrecoverable. So they need to see somebody already has one. On top of that, you're going to need a certain amount of liquidity to prove that you can actually run the building. And then you're also going to need among the GP team collateral, aka a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Brandon, I get the sense that you are a repositioner and you've got other real estate experience, so that I'm sure that'll support that. But what pieces of the puzzle do you intend on fulfilling in your next deal?
Well, my superpower that I found out that I'm very, very good at is capital raising slash investor relations. So I'm very good at doing what we're doing now, meeting people, like-minded people, shaking hands, kissing babies, doing the meetings and the meetups, and raising capital. After the deal is done, I'm also good at the investor relations part with the communications with the investors, whether it be written, verbal, or through social media, newsletters, things of that nature.
I love it. I love it. So let's talk about the buy box then. And when real estate people are asking, hey, what you looking for? What's your buy box? What's your ideal property? We're asking for three main things. First one's geography. Where is it? Which state? Which county? Possibly even which neighborhood? It's going to matter. The second one is size. Now, in multifamily, we usually go by the number of apartment units, which is usually called the unit count. And the reason why it's relevant is because the type of company that takes over 5 or 10 or 15 unit apartment complexes, they're going to be fundamentally different from the ones that focus on 100, 150, 350 unit apartment complexes. So that size matters. Now, of course, there's other forms of commercial real estate. They might go off of square footage, or in industrial, it might even be acreage. But the size constraint still remains the same. Now, the third one, though, is commonly called class. Now, I don't like the term class because it makes it sound like it's only one thing. I split it into two and put them under the label of desirability. The first one's condition, the second one's area. If you're talking about condition, that's how recently renovated was the place, how recently was the place built, how beat up is the place, and then, of course, what sort of luxuries and amenities are included for anybody who is a resident or rents in that location. So that's the condition. Whereas the area, there's the old broker trope of location, location, location. What they really mean is traffic, traffic, traffic. If it's a busy area, it's going to have more baked in value than a place that's basically crickets all the time. And then, of course, the crime rate is always going to be relevant. But since we're frequently talking about residential, multifamily, the school districts are also going to be quite relevant when you're talking about the area. But both the area and the condition are ranked the same way as in grade school, where you have A plus at the top, and then A, and then A minus, then B plus, and so on. So, Brandon, as far as you and your organization, you already mentioned Dallas. What are you guys looking for?
We are looking for buildings that are at least 2 million all the way up to 25 million in price. Reason being, they have to be eligible for agency debt, which is the best debt. So it falls in those in that price range. Second thing, unit count, usually 30 to anywhere from 150 units. That's what we look at. Thirdly, class. Right now we have a 113 unit, which is a Class A property in Louisville, which was built by a developer 2023. The one that we're closing on now in a couple of weeks is a Class B, B plus. That's in a great area, and that was also renovated in 2024. So those are the three types of the criteria or the buy box that we're looking at now.
I love it. I love it. And then let's talk about people. Now, my favorite part about commercial real estate is that unlike tech, where people tend to be a little bit introverted, a little bit even antisocial, people are so eager to make referrals, build new teams, even if they're not a part of it in commercial real estate. And of course, since there are six vastly different roles in a commercial real estate deal, we all do tend to focus on, as Brandon said, the superpower, the part that our piece of the puzzle that we're best at. And at the same time, though, we really need to find the people who really need those superpowers. Now, me personally, of course, like I should mention that everybody, once again, is interested in meeting more investors to deploy more capital into these deals. But me personally, it tends to be the sponsors and KPs I'm most interested in running into because those are the people where I can make a disproportionately large difference with my technical skills as far as online building web-based applications, the marketing piece of the puzzle, PR, and all that kind of fun stuff. I find that I can help them a lot more than other people, such as a typical repositioner, because they need grunts who can be spending 80 to 120 hours a week building more contacts and connections, all that kind of stuff. And it's simply not where I'm at my most effective. So, Brandon, as far as the different roles in a commercial real estate deal, who's out there in the audience that you're most eager to speak to?
Uh, Financiers,
Financiers.
so we have a saying, always be raising, right? So especially as a syndicator, you don't want to find a deal and then you have to be stuck raising on that deal. So you like to have some investors and capital deployers teed up for every deal that you make an acquisition on.
That makes perfect sense. And so that brings us to the last part, which is, of course, how to reach out. And for me personally, I'll sandbag it by talking about myself first. I'm lucky enough to have this really distinct last name. It makes me really easy to find online, especially on LinkedIn, which is where I spend most of my social media time. If you want to appear on this show, or if you play chess and you want to appear on chesswithinvestors.com, connecting with me on LinkedIn is the best way to do that. I already mentioned dandoesdeals.com, which is where the other episodes of these chance encounters are featured. And if you scan this QR code, that goes to my author page. I should also mention, because this is sponsored by Cardinal Financial, make sure you do reach out if you are thinking of creating a fund, a hedge fund, a private equity fund, a venture capital fund, anything like that. I have access to great financial services, even starting with solopreneur packages all the way up to enterprise. But Brandon, if people want to reach out to you, what are the best ways to do it?
Yeah, you can reach out to me via LinkedIn through my name, Brandon Howlett, on my company, Brandstar Capital. We also have a website with the same name, brandstarcapital.com, or you can simply just email me at brandon@brandstarcapital.com.
All right, I love that. And that brings me to the public service announcement, which is not for you, Brandon, it's for you in the audience. If you've been watching this episode of Chance Encounters and experiencing searing pains in your eyeballs, maybe like migraine like symptoms, I'm confident it's because of the downright hideous subscribe button that you neglected to hit already. So just full disclosure, I want a gazillion people to hit the button so that those deadbeats at YouTube start to pay for these videos instead of me. I think that would be amazing. The trade-off to you is that my videos may show up on your list of suggestions, but you can go ahead and ignore those suggestions. Quite frankly, I just appreciate the fact that you spent this time with me. Just like Brandon, I appreciate you joining. This has been great.
Thank you for inviting me. I had fun. I enjoyed it.
Awesome. Thanks.
You want to underwrite something, and there are people charging anywhere from $5,000 to $5,000 to underwrite something for you, and I just don't see that that's fair. I think our goal is to demystify, or however you want to put it, the underwriting process. Is it smoke and mirrors? Is it that simple? In most cases it is, but I think people are just making it way too complicated, and my offer is you bring something to me, we'll underwrite it, no fee. Maybe we'll get some views, maybe you'll find people who are interested in what you're looking at and take it from there. I think our goal is to show people that they can do it themselves, to show them that it's pretty straightforward and easy to do. Some people like to be more conservative. Some people like to be a little more, free-spirited is kind of the way to put it. To go out there and make some money, you're risking money. And, that's kind of the goal here. The goal here is to kind of give you the basics so you can go into that next phase. The whole goal would be to create a spreadsheet basically of what your risk tolerance is, and find something that fits your mold. Instead of underwriting 100 deals, find the deals that make sense to you. Do you want cash flow? Do you want appreciation? Do you want equity? That's all stuff that we'll go through. And I think it'll provide an immense amount of value for people to look at their next possible investment. We made sure that, what you're looking at is viable and profitable, because those are the two major factors when you get into this. When it's brick and mortar and you have assets, it leads you down one path. And you're looking at a strictly online business that may have intellectual property or something to that effect, you have to kind of look in that direction as well. So each bucket is going to have its own little nuances. No catch, just knowledge. I think you're going to get a lot of value from this, and just to show you that it's not something you have to pay for. There's no point in wasting time, money, and energy into something that's not going to be fruitful. When you look at these billion-dollar deals that I've looked at versus the $100,000 deals that I work with, the only difference is capital. There's really not much different to it. I mean, there might be more points on this end, or there might be, some hidden asset on this end, but it doesn't make a difference. It all comes down to capital and how you can make money. We're going to have a lot of fun, and we're going to get into the numbers. We're going to look at why this business is profitable and what we plan on doing. There's no reason to beat around the bush. There's no reason to mail it out, wait 2 weeks for a bad example. We're going to go through it pretty easy, 10, 15 minutes, and you're going to get an answer. You're not going to have to wait. You're not going to have to look deep inside anything. The truth is, it's basic. Bring a franchise, bring a friend, bring a building. I mean, we can underwrite a horse race if you want. We can underwrite just about anything to make sure that there's value in it. We can figure out the Pokemon and Jordans, but a lot of that's just going to kind of be researching eBay.
And what sort of businesses can we underwrite in these sessions?
Bring anything. I mean, we can underwrite a garbage company. We can underwrite. Do it again.
Sure. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a Chance Encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.